Why you're embracing this volatility that's arising from the West Asia conflict?
Good morning, and thank you for having me on the show. The idea here is that, as some of the biggest investors in the world or some of the smartest have said, volatility can be used as a friend of investor. What we have seen at the time of COVID-19 price, there is a possibility that you might actually find a good bargain. Some of these companies that we buy into our portfolios are internally extremely strong in terms of their management quality as well as the capability. But there are sometimes, the exigencies of this kinds that create an opportunity for investors like, our clients, where they probably might be sitting on sidelines for some of the names to enter in, and the volatility today gives them a good opportunity to be there. So like I said, this volatility to some extent is helping. We need to see for how long this continues. What we have seen in the past is that, usually this kind of period of high volatility, stock price, time correction, usually lasts for anywhere between about, probably 6 to 8 months.
Yes, timing the duration of this disruption is the big challenge. Kashyap, so your message is to buy the dip, but buy that dip very selectively. What areas of the market and what businesses then make sense if you're looking for opportunities in what is pricing dislocation? Looking for opportunities in what is pricing dislocation?
So our portfolios continue to be quite, tilted towards auto ancillary. What we have seen over the last many years is that Indian auto ancillary space has made not only its inroad into localizing, most of the parts that we use in automobile here in India, but many of them have diversified not only in the global auto space, but using the championship in processing metal. They are also making inroads into defense, aerospace, and some of the industrial, components also, using the same expertise that they are doing in probably automotive in terms of metal forming. So that's one space where we are, we are tilted quite as of today. The second space where we are quite, have our weights quite built up is Indian pharma, but particularly Indian pharma in the contract manufacturing and contract, research, development and manufacturing space. That space where, what we have done in terms of automotive or auto ancillary globally in terms of supply chain, I think that's where we are now at, certain inflection point to make our inroads into the global scenario as such. So that's another space where we are quite, overweight right now. The third space where we have built our positions slightly better than what the benchmark looks like is in terms of capital goods, where we believe that if you look at even, the FY26 numbers have been rolling out. If I look at within the second half of financial year 2026, within BSE 500 index, if I look at manufacturing companies, the expenditure of plant, property and equipment has grown at a fairly strong pace of about 12% for the second half of this year also. And that builds up on quite a strong pace of growth in terms of expenditure on plant and machinery for last at least about 3.5 years. So I think that's where we are, our weights are tilted at this point of time.
Tell us why, Kashyap, you remain cautious on infrastructure.
So I would sort of, add a caveat over here. We are not cautious on infrastructure, primarily because, if obviously everyone knows about the war in the Western Asia, the consequent impact on inflation. But sometimes the byproduct of that inflation is also that most of the duties here in India are ad valorem in nature. And if inflation is going up, a lot of tax revenues are likely to go up. Some part of that tax revenue, the government is going to spend on infrastructure also. However, if you look at the composition of companies within the listed space, the kind of investments that we look for, that, they should be, the dependence on the government contract should be significantly lower. The balance sheet strength should be significantly strong in terms of net cash, or at least, zero or very low debt to equity ratios. It's very difficult to find, stocks in that space. And which is why what we do is to play through, quite a quasi plays, maybe in terms of cement, construction material, players like that. But so to say, on infra, we are not, sort of cautious, but we would like to play that theme slightly different versus directly.
Thank you for that clarification. How are you approaching IT services names, Kashyap? In the headlines, we said, watch out for Wipro. The shares could be set for some big gains because it's expanded its AI partnership with ServiceNow. Is that making IT services looking a little bit more compelling? And are you seeing some real momentum with AI?
So I think I will break this up into two parts. In terms of short term, I think whatever announcements keep coming from the AI space and consequent reduction or rather consequent improvement in the productivity that a lot of people are expecting in terms of the rollouts of IT infrastructure, in terms of IT administration, I think that's going to weigh on the IT stocks until we find a way to make our space into that AI implementation, as Infosys has been talking about it, Wipro has been talking about it, a lot of mid-cap IT companies are talking about it, but it's going to take its own sweet time before we make that space in terms of implementation. The other part to it is in terms of valuations, where if you look at most of the, probably even large cap or mid cap stocks, the valuations have come down to near probably the earnings yield kind of a number at about anywhere between 14 to 16p. The earnings yield range between anywhere between 6 to 7%. If you look at the dividend yield on IT ETF here in India, almost now today anywhere between 3.5 to 4%. In terms of corrections, I think probably we have seen on a scale of 1 to 10, I think we have already seen anywhere between 7.5 to 8. But in terms of inflection point, in terms of making our way into that, the whole AI supply chain, I think it's going to take, its own bit sweet time. So I would say downside, probably limited right now. But volatility should continue for at least next about anywhere between 6 to 10 months.
Q4 earnings are not showing the full impact of the US-Iran war, are they, Kashyap? That hit may very well be coming in Q1. How bad is that hit going to be? And is that the point where we need to de-risk portfolios?
So I think, obviously the point is right that Q4 hasn't seen the impact of war, because I think it was there only for probably the last 15 days of March. Having said that, I think if you further dissect even that earning, which today seems to be sort of immune to West Asia war, what we have seen is that the earnings of the mid-cap companies and small-cap companies have in fact grown much faster than the large-cap ones. So if I look at broadly the indices, Nifty 50 earnings have grown in a very low 10-digit number. If you look at even operating income, that's grown at a very high single-digit number, but that's nothing great to talk about. But if I look at, let's say, the Nifty Midcap 150 index or Nifty Smallcap 250 index, the EBITDA number has grown significantly higher, probably in early 20s. Even PBT number or profit before tax number has grown equally strong. What we are going to see in Q1 is the real impact of that war. I think it's visible in the early numbers, given the fact that the wholesale price index for the month of April was out about 12-15 days ago. If you look at broadly the output prices, they have grown by just about 8 or 9%, because the manufacturers don't want to antagonize or let's say dent the demand. But if you look at input prices within the wholesale price index or an equivalent of a PPI, input prices have already gone up by about 25% Y on Y. That clearly indicates that margins are going to take a hit. Demand, we are not seeing any slowdown yet. If you look at most of the leading indicators, so we have our payment indicators which come every day. Even for the month of May, we have seen that UPI payments have grown at about 19 to 20%. The electronic fund transfer numbers have grown at anywhere between 13 to 15%. So demand has not taken a knock, but I think margins will take a knock in the Q1 of this financial year.
Yes.
Again, drawing an analogy to the previous war, of 2020-22, we saw a margin contraction for 2 quarters, but second half of that financial year 2023 was significantly better. So let's hope for the best.
Kashyap, final question. Is an RBI rate hike, on the cards in the June meeting in a few days' time to defend the rupee more than anything else?
Yes. So I think I would say the probability of a pause today remains significantly lower. At some point of time, RBI may have to tinker with rates a bit to manage that spread between the global yield and yields here. But having said that, if you look at the market rates, if you look at 10-year GSEC, if you look at 10-year AAA bond, if you look at 10-year AA rated bond, market has already taken a cognizance of the inflation increase and consequent increase in the bond yields. So I think market has already priced that in at this point of time. So any RBI action in that sense, in terms of impact on the market, I would say probably non-consequential.
Understood. Kashyap, you'll leave it there, sir. Thank you very much indeed for your thoughts today. Kashyap Javeri there from MK Investment Managers.